So today we have a really amazing panel of distinguished investors with us today to talk about co-investing and sharing deals in Africa. We've got Andia Chakava, the investment director for Graça Machel Trust, Lisa Thomas, managing director from Samata Capital, Eva Yazari, the co-founder and CEO of Beyond Capital, Kathy Goddard, Edwards, CEO of Firefem Fund Manager in South Africa, and Susanna Davier, joining us from Nigeria. She's the Sustainability and Partnerships Manager for SME NG. So really excited to have this amazing panel who have experience in a lot of different types of collaborative and co-investment on the continent. So I just wanted to quickly introduce AVPA, who we are, because some of you may not be familiar with us. We are the African Venture Philanthropy Alliance. We are based in Kenya and have offices in Nigeria and South Africa as well, and work across the continent. We're also part of a global network. We have sister networks in Europe, Asia, and Latin America who we collaborate with. And our mission is really to serve social investors who are working across the continent. And we're very interested in bringing together different types of investors who are working to achieve social impact. So we work with foundations, corporates, family offices, impact fund managers, private equity, venture capital, angel investors, governments, donors, NGOs, a lot of different types of investors who are all deploying capital to achieve social impact. And so when we look at this space for deploying capital for impact in Africa, we are very interested in trying to help investors collaborate. And when you look at a nonprofit or a social enterprise or a company that is trying to achieve impact in Africa, they face this sort of confusing continuum of capital where they try to move from seed stage to early stage to growth and later stage. And there's all sorts of different investors acting at these different stages. We also look at nonprofits in the market who are trying to scale up their activities, maybe professionalize their activities, who are looking at hybrid models, including social enterprise type funding for nonprofits. And they're also trying to navigate this big mix of capital that's coming into the social space. There's grants, debt, equity, blended finance, technical assistance, all these different types of capital out there. And at AVPA, we're really interested in trying to help investors collaborate with each other across those different types of capital, and help them to collaborate in such a way that enables social enterprises, companies, and nonprofits to sort of move through this capital stream more effectively. And so to do that, we've launched this deal share platform, which is a way for investors to share deals with each other along this continuum of capital. So if you are an early stage seed investor and you are looking for a co-investor for an upcoming deal, you could endorse that deal, put it on our platform, and look for others to co-invest with you to fill out your round. You might be an early stage investor looking for an exit, or with companies or nonprofits in your portfolio who want to raise follow-on capital to scale. So we can connect you to later stage investors to provide that follow-on capital. We're also looking at bringing together investors around blended finance. So how do you connect sort of grant makers with impact investors to fill out blended finance transactions, and through all of this, putting a pipeline out to the market of these different deals that investors can share with each other at different stages along this continuum. So really trying to promote more collaboration amongst philanthropists and impact investors, amongst foundations, corporate social investors, all these different types of actors who are deploying capital. So as we've been developing the deal share platform, we've had a lot of sort of challenging feedback from the market. Will social investors actually use a platform to share deals with each other? People have told us that co-investment relationships especially take time and effort to establish. You have to do due diligence not only on the deal, but on your co-investor, and that's expensive and time consuming. Syndicated deals are rare in Africa compared to other venture capital markets. Investors can be very competitive and secretive about the deals that they put together, or they want to, have co-investors sign NDAs. They want to set up fee structures to get compensated for the work that they've done putting these deals together. You know, it's a lot of people have tried to collaborate over due diligence, and there's a lot of challenges that they find in aligning investor activities and expectations on all these different points when you're looking at investors working together on a deal. When you add impact into that mix, it gets even harder, because then you've got the sort of financial return and impact return expectations of investors that are also difficult to align. And, you know, some investors might be looking for a different level of social impact. They might want to see a company go in one direction to ensure a certain kind of financial return, while another investor says, no, we want to serve these, you know, this low income segment, and we need to stay focused on this social mission. And so we see an immense variety of impact investment strategies in the market. And it's very hard to understand what those might be as you're looking for partners, and how to align those. We see that concessional capital comes from, you know, just a few different donors and foundations. We hope to see more of that coming from corporate social investors, but they're also competing with each other for brand positioning. So all of these different mindsets and ways of doing business really divide investors in the market. That said, we do see promising signs in the market. I took a look at the deal database that we put together for the recent AVPA landscape study, and I found that when you look at all the deals that are done by sustainability aligned fund managers, so those are like private equity, venture capital, accelerators, private fund managers who are deploying capital in sectors aligned with the SDGs. 35% of those deals in East Africa had multiple investors in the round. Interestingly, a lot fewer of them in West Africa than East Africa, just 15% in West. You also see that angel networks in across the continent are growing, but that they are doing syndicated deals as a small but significant portion of their business models. So you see like 17% of the angel network models in West Africa look at syndicated deals. That said, we also see a lot of different funds coming up in the market and projects with really diverse actors working together. So, you know, we saw this interesting project by Visa working with Access Bank in Nigeria a little while back. We just had a webinar the other day with Philips, where they're promoting a new healthcare fund that's bringing together a lot of different types of social investors and actors between government and DFIs and impact investors. So we do see a lot of collaboration happening in the market, but we want to see more. So today we're going to go through the panel discussion with our distinguished investors today to discuss how can we see more collaboration in the market to help entrepreneurs and nonprofits to professionalize and scale up and achieve more impact, and help investors to sort of fill the gaps in their pipelines and exit strategies for each other. So with that, I will turn it over to our panelists. We'll go back to this. So I'd like to invite, I know Andia was running a few minutes late today. I'd like to invite the panelists to just quickly introduce themselves. So Lisa, maybe you want to go first.
Sure, happy to. And thanks so much for having me on the panel today. This is a super exciting topic for us in particular. So I'm Lisa Thomas. I'm the founder and managing director of Samata Capital. We are a gender lens venture fund that's focused on East and West Africa. We focus mainly right now on Anglophone East and West Africa, but we do hope to actually expand into Francophone countries as well. And we focus very much on industry segments that are both high growth, but also have a high preponderance of women somewhere in the value chain. So looking at founders, managers, employee base, as well as if there are women in the supply chain. And so for us, what we do is we focus on agribusiness, consumer products, financial services, health, and then technology. And technology is a catch-all bucket for us. So anything climate related falls into this bucket for us as well, because that's a big piece of what we focus on as part of our impact. Yeah, we will talk more about the deals that we're doing in the stage that we're at a little bit further into the conversation, but I'm very happy to be here. So thank you.
Thanks, Lisa. Thank you very much. Eva, why don't you go next?
Hi, everyone. It is so great to be here. Thank you, AVPA, for organizing this. And I love the chat. I just really want to make that comment before talking about myself. Everybody is introducing themselves, which I think is an incredible engagement tool that we have here in the virtual world. I'm Eva Yazari. I am the co-founder and CEO of Beyond Capital. We are also a venture fund, and we invest in Kenya, Rwanda, Uganda, and Tanzania. I have a family history in East Africa, actually on both sides, my husband and myself. And our focus is really on investing in conscious leaders that are running companies that are innovating around basic goods and services. And we have 3 impact themes to our portfolio: gender, distribution, and livelihoods. But you could see us as a very kind of traditional venture fund in the way that we think about impact being baked into the business models. Our first fund had some great results in terms of 7 million lives impacted, 75% of that number being women, our entire portfolio being 2x eligible and empowering the women in the developing world. And the last thing I would say is I'm really excited for this conversation because I think it'll bring out some of the how-tos of collaborating as investors and hopefully make some bridges that we can continue to work on into the future. So thank you.
Thank you, Eva. Really great to have you with us. Kathy, why don't you go ahead and introduce yourself next? Thanks.
Thanks. So I'm Kathy Goddard, founder of a business called FireFem Fund Managers. We have a strategy which is a fix and build strategy. I'm a business rescue practitioner, so I work with turnarounds and distressed assets. And what we've done is we've combined the opportunity presented by distressed assets with traditional private equity into this fix and build strategy. We also have a gender lens where we can introduce a gender program, and our thinking is that we want to be catalytic around creating mid-sized SMEs, not just small ones, but mid-sized ones, which are women-owned. So over the period of our investment, which will typically be up to 5 years, we will bring some of the women into C-suite and ownership that are already in the business. So there's a program around a development for 5 years. I also do that part of this conversation where I can share some co-investments is I sit on the investment committee of 4 funds. One is a large fund that invests in SMEs in the whole of Africa. 2 are 2 venture capital funds based in Cape Town, and both of them are active co-investors. And then the 4th is an enterprise development fund, which is part of the VW, the automaker, and that invests in its supply chain and is also a very keen co-investor. That's us. Thank you.
Great. Thank you so much, Kathy. Suzanne, why don't you go next?
Okay, thanks, Rachel. Hello, everyone. My name is Susanna Davier. I lead the Sustainability and Partnerships team at SME-NG. Thanks to AVPA for inviting me to join this great conversation. So SME-NG is Nigeria's SME Impact Investment Platform. We are established to bridge the gaps in women's access to finance through gender lens investing. And we do this through 4 pillars. We have 2 impact funds. We have an access to market and financial inclusion fund for women micro enterprises at the bottom of the pyramid. That's called the AB Fund. We have a women investment fund that is targeted at more top tier women businesses. Then we also have an accelerator called She Works Here. That accelerator supports some women-owned businesses to become investment ready, accelerate their growth, and then we provide them access to financing. Women entrepreneurs have to pass through She Works Here to make them eligible for our 2 impact funds. And this platform has a pipeline of over 200 women-owned businesses to date. Then the last pillar is the funding space. This is our annual convening platform. It brings together entrepreneurs, investors, and donors from across the world. It was established to strengthen the Nigeria's entrepreneurship ecosystem by connecting ideas to financing. So with this, we enhance the growth of local innovations that use market solutions to address social problems. So that's just SME NG in a nutshell. I'm excited to be part of this conversation. Thank you.
Great, thanks so much, Suzanne. And I think Andrea has now joined us. Andrea, if you are here, please introduce yourself. There you are. Excellent. Hi.
I was muted. Hi, my name's Andrea Chakava, and I'm the investment director at the Gratiot Michel Trust. The Gratiot Michel Trust is a Pan-African institution that was actually founded 10 years ago, and our mission is really to focus on basically women economic and empowerment rights and leadership. And we do this really through amplifying women's work through 3 pillars, which is financial inclusion, entrepreneurship development, and leadership. I'm the investment director there, and I drive the gender lens investing strategy. And what we've done is really done quite a bit of research, both on our own through our programs and with partners on the barriers that have led to women not getting financing. And then we've used this research to have various partnerships with financial institutions, whether it is to support technical assistance geared towards women entrepreneurs, or whether it is actually to co-create products together. And then we also pride ourselves in building and growing women's networks, one of them which is a network of women in finance, as well as various networks of women in business, which act as a source of our pipeline. And we have various technical assistance programs as well, one which is called Women Creating Wealth, where we not only boost the entrepreneurial confidence of women, but we also apply a know your money approach so that they can get themselves prepared for funding. I have been working primarily on starting a gender lens investing vehicle, just using all our programmatic work as well as individual sort of deal sourcing to really focus on women-owned and led enterprises, as well as really furthering the ones that have products and services that improve the lives of women. Our primary area of operation is in East and Southern Africa, though the Trust has networks in 17 African countries, but in terms of the work that is promoting gender lens investing has primarily taken place in these 2 regions. Thank you.
Thanks so much, Andrea. And thank you very much, everyone, for joining us today. So I want to move into the panel discussion with our speakers. We've got two main things we want to talk about today. The first is looking at sort of, how investors with different social impact and financial return expectations can co-invest effectively together. So I want to explore that a little bit with our panel. And then we'll look at sort of early stage investment as a place where a lot of syndication and co-investment normally happens in other venture capital markets. And so we'll look a little bit at sort of how we can see more syndicated deals and co-investment in early stage investing in Africa, and where the impact elements are in that as well. So Andrea, can I start off with you and ask you just about this project that you recently had at Gratiot Michel Trust, where you teamed up with UNFPA and NILAB to accelerate women entrepreneurs. That's a lot of different partners to work together. So I was wondering if you could talk about, how you got those partners to work effectively together between a foundation, a donor agency, and an accelerator.
Yeah, thanks, Rachel. And whenever I tell people the story, they don't believe me when I say it was UNFPA that came up with the idea. What happened was that the problem was big enough for all of us to come together. UNFPA had been battling with sort of rising incidences within sexual reproductive health and recognized that this was happening amongst the youth, and really felt, which is that one of the best ways to tackle it was to have sort of technology-based solutions that would encourage youth through artificial intelligence, really to engage with one another and ask each other various questions that would support some of the areas and concerns that we were seeing around rising gender-based violence, early pregnancies, and just inadequate sanitary waste. And so they had actually run a program that I was unaware of. And despite the fact that 70% of these challenges do affect the female segment, all the entrepreneurs that were selected as innovators were men, because they were dealing with technology, which is already a male-dominated field. When there was a female co-founder, they were just sort of conveniently in marketing or BD. They weren't really there, and they just felt that they had set up a solution to address a target market. And when the solutions were being interacted with the customer, most of the users were male. So they had to redesign it, and they came to us and said, we need to do this with a gender lens. We didn't think that this would happen. We assumed that we would reach out, and that's how Grasham Michelle Trust got involved. At the point that they involved us, we knew we had the Women Network, and we could mobilize the Women Network, and we could get women to apply. So we came across that we wouldn't do a mixed sort of call. We would do a woman-only call. But we were in the middle of our financing, and we needed to back it up with additional support. So we also went to Global Fund for Women. And we're in Africa, Global Fund for Women. Although they operate across the world, based in San Francisco, they also added additional capital for the cause. And we knew that in order to work with businesses and to strengthen them, we wanted to go with existing businesses. We needed the support of a local accelerator. And NILAB had been doing fantastic work already, sort of upscaling entrepreneurs. So NILAB was the chosen one that would, prepare the businesses, the finalists, to receive money and work with them after receiving the money. So it brought a whole bunch of unlikely suspects together to bring 3 amazing businesses, 2 of which have gone on to raise additional commercial capital. The other was recently featured in the BBC, and the third one has actually merged with a West African solution to expand their market. So we're really proud of that project, and I'd like to say that I think we were all committed to the cause, that we found a way to work together and make it work.
That's really interesting, Andrea. I'm wondering, when you went through the selection process, did you have any disagreements amongst your different partners about how to select the right entrepreneurs, what the criteria should be, how to support them?
Yeah, I think one of the ways we did have disagreements, I'll be quite honest, but it wasn't sort of uncomfortable disagreements that we didn't. I think what helped is that we set up the roles really well. So UNFPA was like, we will bring government. We wanted government to be involved. We wanted the country to know that government is fully behind this issue, and they're concerned with the health aspect of it. So they came with the government stakeholders. We, as Grasham Michelle Trust, promised the women and also the know-how. So we said, you brought us into this room so that we would share our experiences of what women what may make women uncomfortable. And that was all about the mobilization process, how we chose to mobilize the women, how we did the judging. I think if any of you know, women just don't like to stand up and do the 3-minute pitch. We really had to make it sort of more boardroom type, a more friendly feel, who the coaches were and the design of that course. So we butted a little bit of heads here and there with NILAB, who had been doing mixed groups. But I think eventually we came to the end, because when it wasn't working, we learned really quickly about what would work and what wouldn't work. So I think there's still a lot more lessons to be learned in terms of the stage of businesses. A lot of the businesses, although some of them seemed mature, the technical assistance needs were still a lot more than anticipated, even though we gave them a free sort of, tell us what your uses are. We believe the uses, and we will track you later to see how well you do. And they've done extremely well.
That's great. Yeah, I know. I mean, when we look at businesses navigating the early stage market, a lot of them find capital with different types of strings or expectations. This capital is looking for this type of impact. This capital is more commercial. And I know that entrepreneurs can find it hard to navigate that. So I wonder, maybe putting that question to you, Eva, at Beyond Capital, you work as a long-term partner with your investees to help them sort of navigate this balance of impact and profit as they come across diverse investors. Maybe you can tell us about how you've navigated that issue at Beyond Capital in your work.
Absolutely. I want to unpack a little bit of our investment strategy to give some context. So we really do believe that value creation is maximized when companies and leaders are kind of looking with a long-term view. And they're also thinking about having all stakeholders in mind. And as Andia pointed out, commitment to the cause is also very important, but it doesn't mean that there need to be trade-offs. So our investment strategy, as mentioned in my intro, is centered around conscious leadership and investing in conscious leaders that are thinking about all stakeholders. When doing that, I think this conversation gets a little bit easier because there isn't a tension of, I'm only an impact first entrepreneur or even fund, or I am a commercial company. So I think that's really for us where the nexus is very important, is investing in leaders that are having impact, being baked into their business models and a part of their kind of core driving strategy. But the company also has financial viability. We also see companies that are financially sustainable, that have unit economics that add up to financial sustainability. They must have demonstrated operational activities when Beyond Capital invests in them. But there's also a human side to these conversations. So it is not only about the numbers, it is about having a conversation about their priorities and where they see the business going. And to that end, I believe that leadership training plays a pretty key role in grooming management teams to successfully lead their companies as they grow and scale into the future with either double or triple bottom line at the center of those strategies. So for example, one of our portfolio companies in Rwanda and Kenya, we provided access to an executive coach as a group of investors. In fact, relating to some of the questions that you posed prior to this panel, we did collaborate with co-investors to provide the resources that were needed for the CEO. But what it allowed for her to do is think about more than just her financial bottom line. And knowing that she's likely got more on her to-do list because she is serving a population of bottom of the pyramid women, in addition to emerging consumers and employing a workforce of females to sell her products, we were able to provide her with the tools to do that. So I think it's important to be cognizant of that as an investor. And the last thing I would say is that being active, I think, is very important, but also just coaching entrepreneurs to set investors' expectations. And I think we're happiest when our expectations are set in accordingly. And I think it goes for investment. So, making sure that entrepreneurs are communicating that impact is an inextricable part of their business model, or maybe they have specific areas where they are a little bit more impact oriented, and maybe they have specific areas that are more commercially oriented. Really, I think at the end of the day, it comes down to those conversations.
That's really interesting. I wonder, because I think entrepreneurs really struggle with this a lot, about understanding their investor expectations. What can investors do, when you're working together to communicate your expectations with each other and to align those? I mean, what have you seen when you've been, bringing on different partners and co-investors? Everybody has sort of a different strategy. How do you align amongst yourselves?
Amongst other investors?
Yeah.
No, I think that can be a challenge, but I actually do believe that the foundation of collaboration, and this is something that really stood out to me in your initial presentation, is market knowledge. And when we have market knowledge, then we can have a foundation of a conversation that goes beyond that. If we don't all have similar levels of awareness of where we are investing or how we are investing, then I think that there are different thoughts around what investors want to get out of their investments. So I would encourage a collaborative approach. The other thing I would say to that is that, this is not a zero-sum game. I think capitalism 2.0 or 5.0, whatever, wherever we are, is not a game of the pie is finite. So I'm a proponent of sharing due diligence, sharing work, and possibly helping investors that may not have that market knowledge come up to speed with us, and considering their feedback in the process. It's not to say that it will always be the feedback that is perfectly aligned with ours, but I do think that there is a way to come to a common ground.
Sure. Yeah, that makes a lot of sense. I think your point about having a market understanding is really important. And that's something that we're working through as you have investors investing in Africa based in all different places.
Yes.
Suzanne, I wanted to turn to you. SME&G takes a real blended finance approach to SME investment, and you're pulling together all these different types of capital. So I thought, you might have an interesting take on this as well, how investors can align across different expectations, how you can align the objectives and expectations of different actors as you're looking at common investment opportunities. What have you seen in your work?
Okay, thanks, Rachel. So for SME-NG, we take a blended financing approach because we are convinced that a significant influx of capital is required to break women out of the barriers of poverty and economic inequality. So we do grants, we do financing, debt and equity. With philanthropic giving, we know that no returns are expected. So financing from that angle is used to bring our investee companies to a bankable stage where their businesses are more viable. And then this feeds into the public sector and private sector investments, which are used to, invest to help their businesses scale better. And in this aspect, some measure of returns are usually expected. So blending all of this together for us brings down the cost for entrepreneurs when they are eventually financed. So first, the common thread for all of these investors and actors is impact. So SME-NG ensures that investments are made into impactful sectors. We look at agriculture, education, healthcare. This way, all our investors can, tick that impact box, because it's always very easy to demonstrate and show the impact metrics across that will come out of all investments. So for example, how many jobs are going to be created with this investment? How many women will be reached with this? So by just making impactful investments, all our actors are already, aligned. Then secondly, a major alignment is an application of a gender lens, that's SME-NG's focus. So we ensure that all our actors are gender smart investors that support SME-NG's initiatives. We contribute to SDG 5, empowering women and girls. So investors that invest through a gender lens is really very critical for us across board. So most of the different actors are keen on demonstrating gender equality throughout the value chain with their investments. And we've all found out that this helps with improving economic opportunities and social well-being for women and girls. So, if a woman accesses financing, it trickles down to her family and her community. So that's why it's important for us to strengthen gender diversity and also incorporate a gender lens in our investment process with all the different actors. Thirdly, I'll say I'll focus on SMEs. So all players in this field are also, aligned in that regard, and they're willing to invest in SMEs. So alignment by co-investors for us is critical. I'll give an example of our co-investing model for SME-NG's All Women's Accelerator called She Works Here. She Works Here covers the cost of the accelerator for women. We do not charge women a dime to attend the program. It's free for women. However, with our institutional partners, our investors, we are upfront about the need for some kind of fee structure they need to pay the accelerator for connecting them to our investees. And this helps the investors to access the pipeline organically at any time. So with every investor, there has to be that alignment with the objectives and expectations. And a critical requirement is that the interest of all co-investors are aligned as closely as possible. Thank you.
Thanks, Suzanne. I think that's really interesting what you're saying about sort of choosing common impact sectors and looking at, you know, metrics that you can demonstrate what the impact might be in each of those sectors. I wonder if any of the other panelists have sort of been able to use impact metrics to align objectives from the beginning when you're going into an investment with co-investors. Is that something that you all have experience in your investing with?
Rachel, I'd like to bring another perspective to impact. So, and this is where
Sure.
I think co-investing has really worked for us, is that as a first-time fund manager still on a fundraise to first close, we've said at the beginning of this year, we're going to close 2 deals. That's what we were going to do. And we did. And because first-time fund managers have such a difficulty in raising capital and demonstrating track record, I wanted to prove out the theory. So I invited another first-time fund manager into a transaction which I'd originated. And it was, there was a generosity and basically, you know, here's, take half the upside. Let's prove that this works. And having done it, I want to tell you that it does work. So in the first phases, there's some pressures as you both sort of navigate about what you're going to do. And my point on this is that this is impactful to the ecosystem, because co-investing around deal track record for first-time fund managers, especially women-owned first-time fund managers, which is my passion, has created this impact, I think. And especially where you're doing a deal track record and you don't have a fund, you're not compromising your IRR because you're getting innovative around how to finance that. Where 2 brains in the room is better than, 2 funds in the room is actually help. We were collectively like 4 brains in the room, but 2 funds in the room is really helpful because you've got different networks and different access to capital pools. And I've found it has been a fabulous deal. Yvonne, the partner from One Africa Capital, has got a completely different style to me. She has brought a whole lot of, so she helped, and we pulled weight on the DD, the valuation, the investment paper, the IC. We pulled weight on that because this was a sweat equity story. And it was just this great collaboration and sounding board and bouncing around. But not only that, what's come into play really nicely is these 2 different styles in the negotiations with the sellers, and also now sitting at their board and exco. So I think there's, this co-investment brings you this ability to have, someone's in your team, but they're not completely directly in your team, in your fund. And there seems to come some credibility with this independence, where the management team will accept if you both say this, both of you who are 2 different organizations say, actually, that is a term that you should be able to sign off because it should be a board matter, whatever. They're like, okay. So there's 2 funds that are saying this. And so there's this great collaboration. I think you got to make sure your chemistry is correct. And as much as you're saying you want to make sure that your impact's correct, Yvonne's impact is not gender lens, it's a 5FM focus. So I originated the deal, said, Yvonne, basically, this is the impact focus. You okay with it? Yes, okay, good. Now we're moving on. Similarly with the entrepreneur, are you aware this is our focus? And if they say no, it's not, well, then you have a non-starter philosophically, so you're just not going to move. So yeah, I think that there's a huge amount of value add to the ecosystem, and I think it's an impactful strategy for first-time fund managers.
That's really interesting what you're saying, because it's almost like it doesn't matter if your objectives align perfectly as investors. It's more about your personal chemistry with that other investor, your ability to work together with them. So you can bring together these very different actors who have different goals, but then you just need to build that relationship, which takes time, and there really isn't any way around that. Lisa, you're also a first time.
And Rachel, sorry, can I just add
go ahead.
onto that? I think that your collaboration is very portfolio company specific, in my case.
Okay.
So Yvonne might not be the partner for the next deal in the ICT.
Right. Space. Absolutely. But Kathy, on that point, I've had some people tell me that they build up just, a core number of co-investors that they have these relationships with, and then they just work with them, and that you don't, every deal is not a new partner or a new co-investor, that you maintain that relationship over time, and that's really important because you're investing in it. You're nodding emphatically like I'm correct, so I'll take that. Great. Lisa, you're also a first-time fund manager. You've been working on track record deals with co-investors. You're also an angel investor. Can you tell us a bit about what has worked well in establishing these partnerships and co-investment relationships in your work?
Absolutely. So first, I just want to say everything that Kathy said, yes. But also what you just said, Rachel, about having some partners that we work with on every deal versus some partners that come in on certain deals. That's kind of how this has been playing out. So like Kathy, I've been building track record for the fund to go out and do the larger capital raise. And so how we actually approached this was a little bit different. We weren't sure if anyone would want to work with us without seeing some sort of a work product from us. And so what we did was we would go through the entire due diligence process, develop an investment memo, have that cleared by our IC, and we would have a minimum amount that we would guarantee to the company, but then we would work towards going to a much higher amount. So for example, if we were putting in $25,000 or $50,000, we would say, this is what we guarantee to you for what we can do, but we'll go out and help under our umbrella, so they don't have to work with 19 different investors, et cetera, which is actually what happened in one of our deals. They just get to work with us, but we'll go out and raise, maybe it's 150, 200, 250 for that particular deal. And so I think the process that we use to be able to say to people, this is the deal, this is the structure, here's our work product, and all of the due diligence that we went through, it actually made it very fast. People could sign on very quickly to whether or not they wanted to come in. And I think in some cases there's this question of, were they gender lens investors? No, they just thought it was a really good deal. And it happened to be, there was a gender diverse team, which is another thing that we focus on besides just female founders. And so for us, it was very much just trying to make sure that people saw the value that we brought to the table. And it also it helped the entrepreneur in a sense that, they didn't have to have that heavy lift of getting the smaller ticket sizes from a bunch of different people. And I say that in some cases, that's all that's available in the market, right? Yeah. So sometimes, yes, they can go out and get those bigger checks, but more often than not, it's them having to have a lot of these conversations with folks who are willing to put in 10 or 20 or even $50,000. But what they really need is around that's $250,000 or $500,000. And so that's part of what we bring to the value for the entrepreneur as well. In terms of how we structured that, for our, and I resonated when Kathy said this, like, we'll share the upside and all of that. So for our track record deals, the first couple, it was us sharing our due diligence, right? We had done the work. And we didn't actually charge really anything for it. We were just really excited to have more people in the deal with us. But then as we've progressed, we started to share some of the costs, and people have been very happy to do that based on the work that we put forward. And then as we progress, I think what we may do next time is actually attach a little bit of a management fee, because we are doing that on behalf of these investors as well. And that continues to build that track record for us as we move forward. But I think the one other piece that we also really look for when we're bringing in co-investors is, what do you bring to the table in terms of perhaps a skill set that we can draw on, or the company can draw on to really help them? So is it a network? Is it a particular skill set around that particular industry? So we want to be able to have that available for the company. They don't have to access it if they don't need it, or if they don't want it, or if it's not the right fit. But we want to have that available for the company to really provide them with additional resources outside of just the financial piece. Because I think, as we all know, these early stage companies, they need a lot of support, and it's not just about the money. So that's something that we also look for. And we engage with the investors on the front end to see what's the pool, if you will, the database of skills that we're also bringing to the table.
Yeah, that's really interesting. And it's good to hear that you're able to align on the due diligence piece and sort of bring value and bring investors together around managing that process with a lot of different pieces. And before we go to the audience Q&A, maybe I'll turn that question back to the rest of the panel. Have you had experience sort of aligning along fee structures and due diligence as you're putting deals together with partners? Because I think that can be one of the most challenging pieces to get right when we're looking to do collaborative investments or co-investments. Eva, Kathy, Suzanne, Andia, did you have a view on that? Eva, go ahead.
I actually find that one of the advantages of investing in Africa, and we also invest in India, is that from a service provider perspective, is that our transactional costs are, let's say, lower than they might be in the US or Europe, which I think helps support this effort. We have not ever put money into a pot and collaborated or charged a fee. But we have absolutely shared our due diligence just for the purpose of knowing that there is a value to bringing in additional investors into the company, which likely will translate to our returns. I say returns, financial, social, and environmental for those who focus on them. But I do think that they're similarly to how we fund technical assistance and kind of have asked for that to be shared amongst investors. I do think that there's a 100% valid model for doing so. It's just a matter of, aligning around costs. And I know, in traditional venture, there's also the reimbursement from the company. And I know a lot of impact investors don't expect that to be the case, but that could be another way to mitigate some of the costs.
That's really interesting in sort of looking at your eventual either social impact or financial returns as sort of the as the reason that you could go in and share due diligence, or as sort of something that would sort of replace a fee structure, or thinking about impact as that you would get from bringing more investors into a deal as a return as well. So that's a really interesting way of thinking about collaborating. I know we wanted to open up the panel to the audience, and I see there's a lot of questions coming through the chat, and a few of them being answered through the chat. But maybe I'll open up to the audience now. And oh my gosh, there's so many questions. Frank, have you been monitoring these questions coming through the chat? Do you want to maybe flag a couple to the panel? And we can go from there.
Yes, I have. Let me pull the first one here that I think came from Kate. Kate, can you unmute yourself and ask your question? I know Eva's addressed it, but I thought it was a really interesting question. Kate Gardner.
Hi. Yes, I can. Thanks so much for answering my questions. Hi, Rachel. Yeah, I think Eva has answered me pretty extensively in the chat, but my question was just around basically managing the power dynamics that exist between an investor and an investee, and how you manage sort of, and I think it's something that's just inherent in the fact that somebody without capital is asking somebody with capital for it. And that just sometimes puts the investee on a bit of a back foot. And so how, when you are trying to agree your expectations from each other, how do you create the space for the investee to be very honest about what they're looking for and what they're asking for from an investor if they are already a little bit on the back foot? So that was basically the essence of the question.
Thank you so much, Kate. Did any of the other panelists want to address Kate's question as well? Okay, well, that's fine then.
Sorry,
yeah.
I would, could that just be reframed a little bit again? Sorry, I think I missed a piece of it.
Yeah, so Kate has put in the chat.
I think I got what Kate said. She's saying, you know, if she's asking for capital, how does she build the confidence to ask for exactly what she wants when the capital, he who has cash is king, so they say, although there should be queen, but anyway, besides that. I think that actually if you're in the room with someone and you're having a conversation with a funder, they really want to be in the room with you, and they've chosen you for value. And I think you've got to just ask for what you want, and certainly don't take money from the first person that offers it to you just because it's money. And be careful if you feel like you can't ask for something, because your relationship might not be the best in the long run.
Yeah, that's a very good point as well. And
I'll add to that. Oh, go ahead, Andia.
Oh, no, sorry. I just wanted to jump in and say that from an entrepreneur point, because I've sat on both sides, I think if you're engaging with an investor, because it is all about chemistry, and Kathy talked about that even in co-investment, you have to feel comfortable that the person that is working with you or choosing to back you or invest you believes in you and is not seeing you as a tool that is just going to give them some level of returns and is not understanding your own motivations or the challenges within the industry. So I think one thing entrepreneurs don't do is that they don't interview investors back, you know, find out just how many of them have done deals in the particular region, whether they're familiar with the sector, if they've invested in women before. So you want to get rid of some of the nuances. And if you feel uncomfortable pitching, then I would say wait it out and try and build a relationship, because money can be expensive if there's no chemistry to it.
That's a very good point.
Yeah. And I'll just add just one more thing, because this is something that I talk about with entrepreneurs all the time, in that we come to the table and we are trying to assess whether or not it's a good fit between the two of us, because this is a marriage. We don't do short-term debt. You know, we're doing longer-term investments where we're maybe sitting in your company for 3, 4, 5, up to 7 years, depending on how we can actually do the exit. And so we want to make sure that's a good fit. But for entrepreneurs, this is the thing that I say all of the time, is that you may feel this desperation to get some capital and get some stuff moving, but you don't want to have a very expensive divorce or a really terrible marriage because of the fact that you just took the first money that came into the door. Really make sure that that these are the right folks for you. And actually, it's a great signal to investors that you are interviewing them, that you are making sure that this is a right fit, and that you're getting the things, that you're taking the stand and getting the things that you feel are important for your business. People will take that very seriously. And if they don't, if they just keep pushing back and say, no, this is what we want, this is what we want, then it's not the right fit for you. And you should walk away.
It's a really organic process. Yeah, and that's that personality and chemistry and sort of conversation is really important.
Hi, Rachel. I'll also say, you know, too.
Yeah.
So our experience with working with women entrepreneurs as well, it's not all about just investments in form of capital and all. We've noticed over time that funding technical assistance for investees is also very critical, because for these women, it also helps to, you know, enhance their own financial performance at the end of the day. So technical assistance can also be in the form of, you know, non-financial support. We are always aligned in that area, and providing capacity building, you know, to help, you know, build their business management skills, get them investment ready, which in turn links them up to accessing financing eventually. So I think it's always better to look at other areas aside from, you know, financial support. Non-financial support is also very critical.
Absolutely. And that's a great place to plug the AVPA DealShare platform, because we allow companies to seek both financial and non-financial support on the platform, which we think is really an exciting way to look at a deal. We've had a question come in from Kanini. How best to manage a room of investors on a deal where impact is looked at and valued differently? How do we meet in the middle as investors from an impact perspective, and is there a middle ground? Eva, did you have thoughts on Kanini's question?
Yeah, I mean, I think when it comes down to social let's say it's social impact versus environmental impact, all of those considerations can be taken into account in, let's say, a metric system. And frankly, as we know with intersectionality, often those factors are weighing upon one another. I also would just, embolden entrepreneurs to think about truly what kind of investor they want to have. We at Beyond Capital have been in the situation where we have often, been asked to lead a deal if we're not the largest investor, and that's because of our kind of caring about this nexus of financial and social return for the companies that we invest in. But I think that, it comes down, again, I think I've said this a few times, with the thinking around, there's the scarcity mindset of capital. I think, I believe Suzanne mentioned this, or maybe it was Kathy, around not just taking that first money that comes in. There will be more capital that can be aligned with you as you continue to tell your story. I'm raising my second fund. I hope this helps everybody. I've had 220 conversations, and my goal is 500 to raise a $20 million fund. So I think, setting your expectations up front is very important for raising capital. And then it allows me to have aligned LPs. It allows that founder to have aligned investors and, be able to kind of set up their value, as Kathy pointed out, up front in that process. I don't think we will get a room of investors that wants purely financial returns and investors that want much, much more than that to agree. And that is simply okay.
I think that's a very good point. I should note there that our sister organization in Europe, AVPA, has done a lot of work in this space about mapping and aligning impact strategies that different investors use to help those conversations along and to help investors understand each other better. And so that's something that we'll also be looking at next year when we carry on these conversations about co-investment and collaboration. We've had a couple other questions come in. I know it's top of the hour, and I believe Andia had to leave us at top of the hour, but those who are able to stay and take questions, we can probably go for another 10 minutes. Andia, thank you so much for joining the panel today. It was really great to have you with us. So I'll take just, thank you. I'll take just two or three more questions. Julie has sent through a question saying, when a proven business is being launched in a new country by a franchise model, does the original business in the original country qualify them for funding when a proven track record is required? Or would each franchise owner have to build their own track record of success? That's an interesting question, looking at how you invest in different franchise business models. Does anyone have a view on that?
For us, it's very specialized. Franchise funding is quite a specialized niche. And I would say certainly in South Africa, you would have to have some franchise presence in order to get funding locally. Some franchisor presence.
I think that's a very specialized type of investment. We've got another question here from Kozin that says, how does the collaborative process or dynamic differ when dealing with early stage businesses, if at all? Lisa, maybe you have a view on sort of earlier stage versus later stage businesses bringing these track record deals together.
Yeah, I think for the earlier stage, I mean, and there are some entrepreneurs that are very sophisticated and they're able to get out there and do the fundraising process in a really efficient way. But I think largely this is new for them, and they need help. And in some cases, they even need help with determining what's the best financial product to use. So some think that they want to come out and we're gonna raise some equity. We're gonna do a Series A right now, and you need to have that discussion with, well, maybe the best thing to do, because you don't yet have that track record even with your own business yet. You've got a little bit of revenue, but you're not even close to getting to a positive EBITDA at this point. Let's take a look at perhaps doing some convertible notes or a safe round or looking at a revenue share product. And so I think there's a little bit on both sides of making sure that it's the right type of financial product for the stage of the business, and then helping investors, particularly if they're a little bit newer into the process, of why we're doing it this way versus another way, and what support, being really upfront and transparent about the risks of that early stage business, so that those that are coming on the investor side really understand that, this is not a Series A. They're really building up their track record in the business, and there's a lot of work that's going to have to be done, and partially probably with our support in order to get them to that next hurdle. And so, and if you want to be part of that process, great, but who are you going to rely on to help them get there? It may require more of that technical assistance at that point. And so it goes back to this idea of pulling in other resources, and I've not yet used the platform for pulling in technical assistance, but I'm excited to be able to do that at some point as well.
Yeah, absolutely. Thanks, Lisa. Suzanne?
Rachel, I would like to address a question by Joseph on the chat box. He's asking how we're able to deal with entrepreneurs preferring giving up on equity and preferring debt. So with my experience in our accelerator, it comes up a lot when you have more women businesses that are more micro or quasi-micro. A lot of these businesses tend to give up equity. They often prefer debt because they are just starting out. They are early stage businesses that their annual turnovers are even less than 50 million naira here in Nigeria. So they'll rather do debt to expand their businesses better. We found out that most top tier women businesses, those that have been in business for 20 years, 30 years, those ones are, their annual turnover is a lot. So they are better able to take up equity. They're able to allow people to take a stake in their own company. So I just wanted some clarity for Joseph there.
Thank you so much, Susan. I think we'll take one more question that Marvin has sent through. Quick one, what are some pointers for early stage pre-revenue, pre-product startups on the continent? Where do you go to raise funds? How do you ensure to avoid a very expensive divorce, as Lisa mentioned? I think that was a really important point that I thought was good to make, was this sort of later expensive divorce, and what everyone is saying about not having that scarcity mindset of taking whatever capital comes to you. So any advice on Marvin's question?
I sit on the ICF2 VC funds, and they do co-invest, and they do exactly that. So what I would say is try and get into an incubator structure first before you jump into the fund. Most of them, a lot of them have an incubator associated with a bigger fund. And if you get into the incubator, you'll have time to just have a look at the groove, and you're going to get really hands-on help in the incubator. And if you've got a difference there, then you'll know. And normally those check sizes are much smaller with milestones of performance before you have a very big marriage. So maybe it's the prenup stage before you get married.
Prenup. Absolutely.
I would think that's a good way to do it. And I mean, on that one, if you've got more than two investors, so if you're talking about co-investors, just make sure that you as the portfolio company are completely aligned with the two different investors that are coming in, that they're aligned with your forward figures and strategy. Otherwise, you're going to get pulled in the middle like a little rag doll.
Yeah, that makes a lot of sense.
Well, and to add to that as well, we were recently doing a bridge financing. And so what we needed to make sure is that we were actually aligned with, because it was really getting close to a Series A investor completing the documentation to start on due diligence and et cetera. But because we would convert during that Series A, one of the things that we really wanted to make sure of is that we were aligned with that investor as well. And so it was not just, corralling the folks in our pool and making sure we were aligned with the company, but making sure we were also aligned with the Series A investor and what their return expectations and expectations as well as impact expectations were as well. Luckily, it was another gender lens fund, so yay, that very exciting. But that was something. Sometimes that future is a little bit closer than you think. And I think it's good to do that work to make sure that all of that work that you did explaining to the investors of what this investment is going to look like and how the exit is going to be, what the impact is going to be, isn't all of a sudden changed because of a future investor coming in. And so even if that's further out, the way that you do that, at least the way that we do that with our companies, is making sure we're super aligned and that they're also coming to us for advice on what that future capital raise looks like and who those investors should be.
Yeah, that's a very good point, Lisa. And I think you've sort of answered a bit of the question we have from Ludovica from our sister organization in AVPA about how you align exit strategies when considering co-investing and how you look to that next investor. Kathy or Suzanne, did you have any other thoughts on sort of the exit strategies and moving on through the continuum of capital beyond your investment and aligning in that way?
I think it's the same point. It sort of ties back to make sure you're interviewing Lisa's point, interviewing your partners, and actually interview them on what their exit strategies are. And if you've got a co-investment team, make sure that they're both saying the same thing. You're going to have a mismatch if I want to take you to an IPO in Netherlands and they want to do a trade sale
yeah,
in the next year. So I think interview your investors.
Absolutely. Okay, I'll take this one last question because I think it's a good one, and then we'll wrap the conversation for today. But Julie LaFrance from OTT has asked, is there a role in all of this for independent policy research centers, think tanks, to sort of be a trusted broker, to provide data to investors, to undertake market research or customize IMM for key sectors? Where do you get your context specific intelligence? So sort of an enabling environment question, what kind of support do investors need from the ecosystem, from firms and consulting firms that are able to provide services to support co-investment? Go ahead, Lisa.
I'm happy to take that unless Suzanne or Kathy, you'd like to jump in as well. Okay, I'll go ahead. So I think this is something that I've been working on a project with the MasterCard Foundation as well. And we're talking constantly about what are the policy barriers that are out there or other infrastructure barriers. And I think where the like OTT consulting and other think tanks could be really helpful is getting more research out there about the fact that there are deals being done, that they're talking about where the trends are in the market. And I think this isn't so much for those of us who are already there, that we always are wanting more data and more research, but this is to crowd more people into the markets. Because I think we all know that there's still this dearth of capital across the entire spectrum for companies on the continent. And so if we have more research coming out and it doesn't, it's not the 5-year-old data that we're continuing to use and et cetera, on returns, trends, valuations, just different risks that are being mitigated in the various markets. I think that can be extremely helpful from these organizations.
And I think there's a role for these sort of agencies to facilitate graduation. So they might pick up something, get it going, and then push it through up the ecosystem into bigger funds. I think there's a good place for that.
Absolutely, and that's really what we're trying to do at AVPA by sort of convening different investors along, from early stage to later stage, and who play different roles in the capital markets to help you collaborate with each other. So I want to wrap it there because we've already gone over the hour, and we've lost 2 panelists. But thank you so much to Kathy, Suzanne, and Lisa for joining the panel today. Your insights have been really exciting and interesting. Thank you to everyone in the audience for your questions. We look forward to continuing to engage on these topics. We will continue to have discussions around investor collaboration, around co-investment, with different sort of focus areas as we go into 2021. And we look forward to continuing this conversation with you all. In their absence, thank you to Andia and to Eva for being with us. And we also always want to say thank you to one of our major donors at AVPA, which is the United States African Development Foundation. And they have helped us to produce our landscape study and get a lot of the insights that go into the market and these conversations. So thank you to all of our AVPA donors and all of you, and everyone. Have a great day. The session will be recorded, it has been recorded, and we will make sure to share it with everyone following the call. So thank you so much.